All right, today we're going to dig into something really interesting. It's an analysis that lays out a path for XRP, but this isn't about hope or speculation. Nope, this is all about pure market math. Let's jump right in.
Okay, let's just get it out of the way. The big question, is a $50 XRP even possible? Is that just a total fantasy? Well, the analysis we're breaking down today says, hold on. It argues it's not about wishful thinking at all. It's about market math and a very specific chain of events.
So let's really dive into this. The whole argument here, the core thesis, it's not built on hype. Not at all. It's about a calculated pathway, a potential roadmap for how XRP could get to that $50 mark by December 2025. And it all hinges on market structure and a couple of really big catalysts.
And the whole thing kicks off with one single massive catalyst. We're talking about the potential approval of a spot XRP ETF. The analysis positions this as the trigger, the one event that could start the whole domino effect. Now, this isn't just some what-if scenario. The analysis makes it super clear. These are real filings. They're sitting right there with the SEC, and they're from some of the absolute biggest players in the game. I mean, look at this list. We've got at least 6 major issuers all lined up, ready to go.
Okay, so when could this happen? The analysis actually zeroes in on a really specific timeline. The idea is that the SEC might be lining up all its decisions on these applications for a single window, right around October 2025. And if those approvals come through, boom, you could have a whole bunch of ETFs launching at the exact same time in that last quarter of the year.
Right, so we've got the catalyst, this wave of potential ETF launches. But so what? How does that actually move the needle on price in a big way? Well, according to this argument, it's all about a classic textbook economic situation, a massive supply shock. And this is where we get to the real heart of the conflict. Think of it like this. On one side, you've got this potential tidal wave of new institutional-grade demand just waiting to crash onto the shore, all thanks to these ETFs. And on the other side, a really, really small amount of XRP that's actually up for grabs on the open market.
And when I say tidal wave, I'm not kidding. This isn't a little trickle of new money. The analysis we're looking at cites estimates. We're talking over $5 billion in net inflows in the very first month. $5 billion. All of it trying to squeeze into a very, very tight market. So let's talk about that supply side for a second, because this is so important. Look at this breakdown. A gigantic chunk of all XRP, we're talking 36 billion, is just locked away in escrow. It's not touchable. Then you've got another huge slice held by long-term holders who aren't selling. So what's left? This tiny, tiny sliver right here, the free float. And that's what has to absorb all 5 billion of those new dollars.
Okay, but here's a really crucial piece of the puzzle. The argument isn't just, oh, institutions will magically show up. No, it's that the actual plumbing, the financial rails needed for big money institutions to even touch XRP, well, they've already been built.
And if this sounds familiar, it should. It's the exact same playbook that we saw with Bitcoin and Ethereum, right before their ETFs got the green light. You first set up a regulated futures market on the big trusted exchanges like CME and Coinbase. That gives the big players liquidity, a way to figure out the price, and, super important, a way to hedge their bets. It basically builds the foundation that a spot ETF can then sit on top of.
The analysis actually has a great name for this, the optimal institutional on-ramp. It's the whole shebang. Because you got to remember, big institutions don't just want to buy something. They have to be able to manage their risk. Having both the spot ETF to buy the actual asset and the futures market to hedge lets them do exactly that. It's the complete package that makes it a serious, viable investment for them.
Okay, so let's recap. We've got the catalyst, we've got this huge supply and demand problem, and we've got the institutional rails already built. So, how does this all add up to $50? Let's get into the math that the source lays out. And just a quick note, this is an illustrative scenario, not financial advice, of course.
All right, so the scenario basically pictures this capital flowing in waves. Wave 1, the initial ETF launch, maybe $5 to $8 billion right out of the gate. But then, right behind it comes Wave 2, another $5 to $10 billion from arbitrage traders and big financial advisors rebalancing their portfolios. So you add it all up, and you're talking about maybe $10, even $18 billion of new demand. And where does it all have to go? It has to smash into that tiny little fraction of XRP that's actually for sale. You can just imagine the kind of upward pressure that creates.
And honestly, this visual just says it all, doesn't it? Look at this.
You've got this huge bar for potential demand, and it's bearing down on this little tiny bar of available supply. It's like trying to force an ocean through a garden hose. Something's got to give, right? And the argument here is that the thing that gives is the price. It has to go up.
And this could kick off something the source calls a liquidity flywheel. It's a pretty cool concept. Basically, it's a cycle that feeds itself. The first wave of money pushes the price up. That makes the ETFs look really successful. Their total assets, or AUM, gets bigger. That success gets noticed, which attracts even more money, which pushes the price up even more, and you see where this is going. The wheel just keeps spinning faster and faster.
This all leads to what I think is the most powerful takeaway from the entire analysis, captured in this quote. It totally reframes that $50 number. This isn't about pulling a number out of a hat or making a wild promise. It's about laying out a logical pathway, a potential outcome if all these dominoes, the ETF, the institutional money, the supply crunch, if they all fall in exactly this order. It's a pathway, not a promise. I think that's a really important distinction.
And really, this is why the whole thing matters so much, and it goes way beyond just a price target. What this analysis is really describing is the final step, the graduation day, if you will, for XRP. The ETF isn't just a trading vehicle. It's the thing that could cement XRP's place as a real piece of regulated institutional financial infrastructure, a settlement asset that the big players can finally use easily and safely.
So that leaves us with one last big, thought-provoking question, doesn't it? The question this whole analysis really builds to. If you have a huge catalyst, like a wave of ETFs smashing into a market that you know has a super tight supply, is a massive price explosion just inevitable? Is it just simple math at that point? Definitely something to think about.